Hello, everyone. This is Stephen Balch, your instructor for Intro to Microeconomics online at Ozarka College. Today, what I'm going to do is review over some of the Chapter 8 assignment questions and I'm going to kind of explain what answers I was looking for on the assignment because some of you, I think, had some problems understanding some of the concepts. So I'm going to kind of go over these with you. The first question asked you to explain the features that determine the structure of a market. Okay. Some of you listed these but didn't explain them. Some of you, instead of explaining the market structures or the features of a market structure, uh, you instead explain the four types of market structures. So make sure that you read each question carefully. But basically, the things that determine market structure are basically the number of suppliers in the market. For example, in perfect competition, you have many sellers or suppliers in the market. Um, Whereas in monopoly, which is on the opposite end of the spectrum of market structure, you have only one supplier. All right. So the number of suppliers impact market structure in the sense that if you have so many suppliers in the market that um, no individual supplier has any control over the price, then that creates that perfect competition type of market structure. All right. So the number of suppliers is one characteristic or feature that determines market structure. You also have the product's degree of uniformity. In other words, is the product a homogeneous product, basically the same product uh, throughout the market that every seller or supplier is providing in the market, or is the product differentiated? Can the product be made different uh, by different producers in the market in order to um, maybe warrant a higher price than other competitors' offerings. So the product's degree of uniformity, for example, in a perfect competition market structure, you learned in Chapter 8 that you're basically selling a commodity product like wheat or corn. Okay, and that those are uh, products that can't easily be differentiated. In other words, every supplier is basically selling the same basic commodity product in the market. Um, but in other market structures like monopoly or monopolistic competition or oligopoly, uh, you are normally selling a product that can be differentiated. For example, the automobile industry. Even though every auto manufacturer produces the same basic automobile, it can be differentiated in the sense that you have different styles and types of vehicles and sizes and colors and features. So there are ways that you can differentiate that particular type of product. Okay, so the degree of uniformity, uh, in other words, is the product homogeneous, the same, or can it be differentiated? Is it a heterogeneous product? That's going to determine what uh, type of market structure you have as far as perfect competition on one end, monopoly on the other. All right. Also, the ease of entry into and exit from the market. So, for example, in perfect competition, you learned that there are no barriers to entry. Firms can readily or easily enter the market and leave the market, all right, as they see fit. Whereas in other market structures, it's more difficult because of barriers to entry. Um, so maybe it could be a control over a input into the production process, or a um, some other barrier to entry, and you'll learn about several different barriers to entry in chapters 9 and 10. Okay, so ease of entry into and exit from the market. That's going to determine what type of market structure you're facing as a firm. Also, the forms of competition among firms. For example, in perfect competition, the most simple market structure, you have the highest level of competition that you can possibly have among firms, where no individual competitor has any control over the price. So the only thing that you have control over as a perfect competitor is how much you produce. Whereas in other market structures like monopoly and oligopoly and monopolistic competition, there is some competition among firms, but it's not as competitive because the product can be differentiated. Okay, because there are fewer firms producing that particular product as well. So again, these are the 4 things I was looking for you to explain in question 1. And like I said, some of you didn't read the question correctly, and you talked about the 4 types of market structure instead of the features that determine the structure of a market. Okay, and of course, depending on what kind of market structure you're facing as a firm, you're going to your decision as far as how much to produce and at what price to charge is going to be different depending on what how you fall in that spectrum of market structure. All right. There are some firms like perfect competitors in a perfect competition market structure that have no control over the price. So all they're going to be able to do is determine how much to produce to maximize profit or minimize loss. Whereas other firms, the other 3 market structures, they have some control over the price. And so they're going to have to determine not only how much to produce, but also what price to charge. So that's why these other 3 market structures are a little more complex than the perfect competition market structure. All right. All right. Now, question 2 asked you to kind of explain the basic characteristics of a perfectly competitive market structure. All right. So in perfect competition, you have many buyers and sellers, and no individual buyer or seller is large enough, represents a large enough part of the market to have any control over the price. All right. So they're a price taker. And also, again, in perfect competition, you're basically selling a commodity product, a standardized product, a product that can't be differentiated. So you're basically one producer is selling the same exact product as another seller. All the sellers are basically selling the same basic product. All right. Also, in perfect competition, you have fully informed buyers and sellers. The market price is known by all buyers and sellers, and so there are no surprises. There's not a situation in perfect competition where the buyer is going to know more than the seller or vice versa. Everyone has the equal information, has all the information that's available about that product and the current price of the product. All right. The last characteristic of perfect competition is there are no barriers to entry. And of course, I talked about this a minute ago, but firms can easily enter the market or exit the market. There are no barriers. There's no one firm that has control over the supply of a particular input into the production process like you would have with monopoly market structure. And it's very easy to enter and exit the market because there are no barriers there. Okay. All right. Also, in perfect competition, again, each individual buyer or seller has no control over the price. They have to take whatever the market price is. They face a perfectly elastic demand curve for their product. So they can sell all they want at the market price, but they can't charge anything higher than the market price, or their sales will fall to zero. Okay, so we call a perfect competition, a firm that's operating in perfect competition, we call them a price taker, because they must take whatever the market price is because they have no control over it. All right, let's go see. And of course, again, demand under perfect competition, the market price is determined by the intersection of the market supply and demand curves. And so the demand curve facing each supplier is a horizontal line at the market price. And remember from earlier chapters, a horizontal demand curve is basically a perfectly elastic demand curve. All right. And so this is what this Exhibit 1 in your book and also on this PowerPoint presentation shows what the market demand and supply is in perfect competition, and how the market price is determined by the intersection of those two, and then what each individual firm's demand curve looks like. Again, it's a perfectly elastic demand curve at the market price. All right, so just make sure you understand that. Now, the next question, question 3, asked you to explain how a firm in perfect competition, how a perfect competitor, in other words, maximizes economic profit. Well, in the short run, a firm in perfect competition is going to maximize profit by finding the quantity at which total revenue exceeds total cost by the greatest amount. All right. And of course, all of these acronyms that it shows in chapter 8 and will be continued in chapters 9 and 10, make sure that you understand what these mean. Again, total revenue is basically just your the price, the market price, multiplied by the number of units that you're selling in the market. So total revenue, or TR, make sure you understand what that is. Total cost is normally uses the acronym TC, and then profit is just your total revenue minus your total cost. And that's true of any firm, whether it's a perfect competitor, monopoly, monopolistic competition, or oligopoly. Doesn't matter what market structure you're facing as a firm, your profit is going to be determined the same way. All right. So now, as far as short run profit maximization, if total revenue exceeds total cost, right here, then you're going to have an economic profit in the short run. If total cost is greater than total revenue, then you're going to experience an economic loss in the short term or short run. All right. Now, short run profit maximization. In order to determine short run profit maximization, you need to calculate your marginal revenue and your marginal cost. All right. Because it's basically the point where your marginal revenue equals your marginal cost is going to be where you're going to maximize profit in the short run. All right. So marginal revenue is just the change in total revenue from selling another unit of output. Average revenue is the total revenue divided by quantity. And so for a perfectly competitive firm, the marginal revenue is going to equal the price, and it's also going to equal your average revenue, because you have no control over the price. You have to take whatever the market price is. So whatever that market price is also going to be your marginal revenue, going to be your average revenue. Now, that's not always going to be the case. In chapters 9 and 10, when we talk about other market structures, their price is not going to equal their marginal revenue and average revenue. Okay, so kind of keep that in mind. Now, marginal cost, we normally use the acronym MC for that. So make sure you understand what these acronyms mean, because again, we'll continue using them throughout the semester. Now, in order to maximize economic profit, basically you're going to produce, as a perfectly competitive firm, you're going to produce more as long as each additional unit adds more to total revenue than it does to total cost. So the basic golden rule of profit maximization is that any firm, whether it's a perfect competitor or a monopoly or any of the other market structures, doesn't matter. The golden rule of profit maximization is you're going to produce as a firm at the point where marginal revenue equals marginal cost. At that point, you've added as much to your profit as you possibly can. All right. You wouldn't want to keep producing after marginal revenue equals marginal cost, producing more units, because then your marginal cost is going to then be greater than your marginal revenue, and you'd actually be losing, or you wouldn't be maximizing your profit. You would be kind of taken away from that maximum profit point. So it explains all this in your book, and I just thought I would kind of go over that. Now, that golden rule of profit maximization, make sure you study that, because it applies, again, not only to perfect competition, but it also applies to monopoly, to oligopoly, and monopolistic competition market structures. That's why it's called the golden rule, because it applies to every firm, all market structures. Okay? All right. Let's see. So this Exhibit 3 is a good thing to look at because it kind of shows kind of the relationship between total cost and total revenue, and then how it applies as far as looking at marginal revenue and marginal cost. So basically, if you're looking at total values, total revenue and total cost, you're going to find basically on a graph where in order to maximize profit, you're going to find the point where total revenue exceeds total cost by the greatest amount. At that same production level, you're also going to, it's going to be the same point where your marginal revenue equals your marginal cost, which in this case is point E on this graph. Okay, this is marginal cost right here. This is the marginal cost curve. And then your marginal revenue curve is that horizontal line, because remember, a perfectly competitive firm faces a perfectly elastic demand curve. Okay, so the price is going to equal your marginal revenue and your average revenue as a perfect competitor. All right, now in some cases in the short run, a firm in perfect competition is going to experience a short run loss. All right, so let's look at this. Total cost, remember, is your fixed cost plus your variable cost. All right, so in the short run, any firm that shuts down, in other words, and what we mean by shutting down is producing 0 units. Okay, remember, in the short run, it's not enough time to completely get out of the market, to completely go out of business, because you're still going to have a fixed cost, at least one fixed cost in the short term. You're going to have a fixed resource that you're going to have to pay for, like your plant. And so in the short run, a firm has to pay fixed cost. All right, we talked about that in previous chapters, and in this chapter. So if total cost is greater than total revenue, we know that we're going to experience a short-run economic loss. But when we're faced with a loss at all levels of production, no matter how much we produce, we're going to lose money. What we have to do in the short run is determine whether we want to go ahead and produce at a loss or produce nothing. In other words, shut down temporarily. Okay, and so what the decision here comes down to, you're going to go ahead and produce at a loss in the short run as long as your total revenue is greater than your fixed cost. In other words, as long as the price that you're having to take in the market is greater than your average variable cost, you're going to go ahead and produce. The reason for this is because as long as your price is above average variable cost, you're making back all of your variable cost plus a portion of your fixed cost, which is going to give you a smaller a lower loss than if you completely shut down and have your loss equal your entire fixed cost. All right. So again, you're going to go ahead and produce at a loss in the short run as a perfect competitor as long as the price is above your average variable cost, because your revenue is going to cover all of your variable costs plus a portion of your fixed cost. So your loss in this case is going to be less than your fixed cost. All right. Now, a firm facing a loss in the short run in perfect competition will go ahead and shut down temporarily in the short run if total revenue is less than variable cost, okay, or the price is less than your average variable cost, because at that point, it's just going to be better to go ahead and shut down. In other words, produce 0 units temporarily, and then kind of wait and see what the market does later. Because by shutting down, your loss is just going to equal your fixed cost, and you're not going to lose your also part of your variable cost as well. All right. So that's the basic kind of shutdown decision in the short term or short run when you're faced with an economic loss. All right. And this Exhibit 5 just kind of shows this to you graphically. So in this case, our total revenue curve is completely below our total cost curve. All right. But there is a minimum economic loss in the short run that you want to try to get to. You know, you're going to try to you're going to produce at that point where your total cost is as close to your total revenue as possible. Okay, so that you're minimizing your loss. And then down here on the bottom portion of the graph, it's just showing this to you in marginal values or average in average values as well. So you're going to minimize your loss by producing at point E in this case, because at that point, your total cost and total revenue is as close together as possible. All right. All right. Now, let's see. One other thing I wanted to go over with you is this Exhibit 6 in your book. It's in your book. It's also on the PowerPoint slide here. This is a real good thing to look at just to kind of study the basic concepts of the perfect competition market structure and the break-even point, shutdown point, so forth. So let's kind of go through this very quickly here. Now, basically what we're looking at here is we've got our marginal cost curve right here. We've got our average variable cost curve here. We've got our average total cost curve here. And then we've got 5 different prices that we're looking at as far as a perfect competitor having to take whatever the market price is. So let's say the market price is at a level of P5 up here at the top of the graph. Well, at that point, our marginal revenue or price is higher than our average total cost. And so we're going to make an economic profit in the short run at a price of P5. Okay. Now, let's say the market price, the price you're having to take in the market goes down to a level of P4. Well, at that point, our marginal revenue equals our marginal cost. Or no, I'm sorry. Our price equals our average total cost. And so at that point, that's the break-even point. That's the point where we're not making a profit. We're not losing any money. Basically, our total revenue equals our total cost at that point. Okay? So we're basically making 0 economic profit in the short run when we have a price of P4. All right. At a price of P3, you'll notice now we're getting below our average total cost curve. So the price we're having to take in the market is completely below our average total cost curve. So at this point, where we know we're losing money in the short run, But at a price of P3, we're going to go ahead and produce at a loss because the price that we're having to take in the market, a price of P3, is still above our average variable cost, which is down here. Okay, so our average variable cost is this red curve. The price that we have in the market right now is a price of P3. So again, as long as your price is above average variable cost, you're going to go ahead and produce at a loss in the short run. Because at that point, you're making back all of your fixed costs. I'm sorry, all of your variable costs plus a portion of your fixed cost. All right. So basically, the space between average variable cost here and your average total cost is your fixed cost. So at this price of P3, you're basically making back again all of your variable cost and a portion of your fixed cost. So your loss is going to be less than what it would be if you completely shut down and produce nothing, because your loss is still going to you're still going to pay your fixed cost. So instead of having your loss equal your entire fixed cost at a price of P3, you can make back all of your variable cost plus a portion of your fixed cost. So your economic loss is going to be less by producing, continuing to produce at a price of P3. Now, let's say the market price gets all the way down to a price of P2. That is the shutdown point. Okay, at that price, we're basically the price that we're taking in the market is equal to our average variable cost. So at that point, you're really indifferent as to whether you produce or shut down and produce nothing, because either way, your loss is going to equal your fixed cost. Okay, your loss is going to equal basically the difference between your average total cost, a space basically between your average total cost and your average variable cost. All right. So in other words, your loss is going to equal your fixed cost, whether you produce nothing or you continue to produce at a loss. All right. Now, at a price of P1, here, you'll notice we're now at a price below our average variable cost. At this point, we're going to definitely shut down in the short run because we would be able to we wouldn't be able to even make back our variable cost, our average variable cost. So it would be better to go ahead and shut down and produce nothing and have our loss equal just our fixed cost, rather than losing a portion of our variable cost and all of our fixed cost. Okay, so just kind of make sure you kind of study this Exhibit 6, because it kind of takes a lot of the basic concepts of the decisions that perfectly competitive market structure faces, and kind of puts it in one graph here. So you have the break-even point all the way down to the shutdown point. Okay, so kind of study that. And that's really all I wanted to do today, is just kind of go over kind of the high points of what I was looking for as answers on the assignment. Hopefully this helped you a little bit to better understand what I was looking for as far as answers. And also, of course, understanding these basic concepts is extremely important, because a lot of these things you'll be reintroduced to in chapters 9 and 10, but then you'll also get into a little bit more complex decisions because of the power over price that the other market structures have. And so it's going to make it a little bit more complex types of decisions. All right. So just let me know if you have any questions about these concepts, and I will see you in the next video. Thank you.